Who better than Marc Faber, the editor and publisher of the Gloom, Boom and Doom report, to join us on the show and dissect which way the markets are headed, what could be dictating the market mood from here, and especially given the heightened talks of, or rather fears of, a trade war, how is it that investors at large should be approaching the markets? For this exclusive chat, Dr. Faber, morning. Thanks so much for joining in. Do you think the selling of equity markets, because of the heightened fears around a global trade war and the global tariff between US and China, is overdone? Do you see a case for markets to correct further, or do you think this is it?
I was expecting a correction a long time ago. It hasn't happened, but when it then happens, it happens more severely. But it hasn't happened yet very severely in the US. We're down actually not even 10% from the January 26 high. In India, we're down about 10% from the January 29th highs. But it's not yet a big correction by historical standards. A correction would be, say, a 20% decline, and the bear market would be something like a 40% decline. So it's nothing very serious yet, but it may become very serious in future.
Right. Dr. Faber, the two big arguments for bull markets were that rates globally are going to come down, and globalization is leading to more opportunities for MNCs. Are both reversing as rates are now going up and tariff making, or other tariff talks are making global market opportunities very limited?
In terms of interest rates, we have, by historical standards, been at the lowest level in the history of mankind, from, say, 3000 BC up to now, so 5,000 years of history. We've never been this low. In the US, the low point for the 10 years Treasury was 1.37% in July 2016. And in Europe, as you know, we have, in many cases, negative interest rates. Now, recently, they've moved up a little bit, but in Switzerland and in Japan, basically, we still have negative interest rates. And we've had them, essentially, for the last 9 years. So this is a very unusual situation. I don't think anyone could expect interest rates to stay this low for much further. So that a rising tendency is there is probably the reality. But recently, the Treasury bonds in the US have sold off quite considerably, and I believe that we could have one more decline in interest rates as a result of a recession that may happen later on this year or next year. So I actually went long some Treasury bonds in the US. Now, concerning global trade, you're right. The idea was that multinationals in Europe and especially in the US could open up new markets like China and then sell their goods into these markets. But now conditions have somewhat changed, in the sense that it's the Chinese and other emerging economies that sold their goods into the US. So to some extent, it backfired on the US. And as you know, the US is not a fair player, and they reacted negatively now with essentially these trade sanctions or trade tariffs, which, in my view, are not very negative for China and other countries, but they're very negative for the US. So this is my assessment of the situation.
Now, Dr. Faber, liquidity has been taking markets up in asset value. Do you think liquidity will dry up and markets will go down?
Well, there is a lot of liquidity, especially here in Asia. I mean, I see wealthy people have liquidity. But offsetting that is, of course, also a lot of debt. And the debt level in the world nowadays as a percent of the economy is more than 50% higher than it was in 2007 before the crisis occurred. So we had this modest economic expansion since June 2009, but it was driven by money printing and it was driven by credit. And I think we've reached probably the level of credit where additional credit will not do much good.
Now, Indian markets have corrected 10%. What is your view on India, and specifically, where do you think Indian markets are headed?
Well, I mean, I think that India, from a longer term point of view, is still an attractive proposition. But as you know, India is not exactly a problem-free country. And there is leverage in the system, and there has been fraud, as you know, and there are still some unsettled political events that may happen. So I'd say, given that the market has actually rallied very strongly over the last few years, and that we reached a high here at 36,400 on January 29th, I think we could easily decline by around 20% from the high. That would take us below 30,000. Long term, as I said, I'm optimistic, but I think we have to realize if one asset class goes down, fund managers will also sell another one, even though the fundamentals may be favorable, but they just get out and build up their liquidity, because on the institutional side, the funds are holding very little liquidity. So they may build up liquidity, and that can then bring about selling pressure everywhere.
Right. Oil prices, Dr. Faber, have been going up. We're already nudging that $70 per barrel mark. And political uncertainty going into the 2019 elections are the biggest risks for Indian markets. How do you think these two would play out?
I don't think the dynamics have changed a lot. As I said, I'm still kind of the view that over the next 10 years, you will make more money in India than, say, in the US. In fact, looking at the various economies around Asia and the world, I would feel reasonably confident to say that India has a growth potential of, say, approximately 6% per annum, which, when I tell that to Indians, may not sound a lot, but it's much better than Europe and the US. So I don't think that this is a problem. The problem in India is more that Modi has some difficulties in reducing the still enormous bureaucracy. It may have improved somewhat, but still a lot of bureaucracy. And there are still a lot of bad loans on the books of banks. And then there's also the valuation issue. Blue chips in India, they sell at 40, 50 times earnings. I do not consider that to be a low valuation. So you understand, these factors could easily contribute to a peak to trough decline of 20, 30%.
So what is your view on, what do you think global investors are now viewing the entire PSU banking scam in India? Do you think they would be reluctant to buy financials?
Well, I don't know all the details because I really follow global markets, and I don't follow Indian specific situations that closely, for the simple reason that in India there are millions of people that follow it very closely. So you don't need my opinion on this particular case. But I think it's quite endemic to India that there is a lot of fraud in the system or irregularities. This has always been the case. Now, is it worse than in America? Probably not. I think America is probably the most corrupt country in the world. But the corruption there is done officially. So that we have to distinguish. But basically, I wouldn't sell Indian stocks because of that scandal. But I would essentially, and I have reduced positions because I was interviewed several times about India when the market was below 25,000. I thought at that time it's a buying opportunity. I don't think it's a buying opportunity now.
Just a last word, Dr. Faber, on global economics, about the tariff warfare. Do you think that U.S. versus China tariff war will get worse before it stabilizes, which in turn creates huge uncertainty for investors globally?
As I said, I think that the tariffs are going to backfire on the U.S. very badly. Because you have to understand, the U.S. was economically very powerful until, say, the early 1980s. The saying was at the time, in the 70s and early 80s, if America sneezes, Asia catches a cold, because all the exports went to America. But this is no longer the case nowadays. You take steel. 2% of U.S. steel imports are from China. And only 1.5% of Chinese production of steel is exported to the U.S. So even if the U.S. wouldn't buy any steel at all from China, it wouldn't matter to the Chinese. At the time of Davos in February, a Chinese owner of the world's largest bus company was interviewed, and they asked him about U.S. tariffs and U.S. threat of a trade war. He said, we really don't care. We export our buses to 150 different countries in the world. What do we care about the American market? And that is true for many companies. The American market is no longer that relevant. China exports more to commodity producers than to the U.S. And the same applies to the South Korea and so forth. So what has changed in the last 30, 40 years is that whereas Asia and the world was American-centric before, the world has become much more centric towards China in Asia. And it has become a much more multi-dimensional economic world where the U.S. has lost a lot of its importance, relatively speaking. It has also lost a lot of prestige because of their failed interventions in Iraq, in Syria, in Libya, in Afghanistan. Everything they touched, they messed it up.
Dr. Faber, such a pleasure speaking with you today, and so glad that you could take time out from your busy schedule and speak about what you feel the Indian markets and global markets at large are going to do, and which way are they headed in the next 1 year as well as 10 years. And in 10 years, Dr. Faber does believe that there's more money to be made in India as opposed to U.S. equities.